Coming up today, stocks stage a comeback on weaker inflation data. Goolsby is still dovish. Consumer sentiment rises. The latest data and seasonality. Warren Buffett buys the dip. A review of 2024. The outlook for 2025. And why I think stocks just bottomed. It's the last daily market review of the year, guys. Let's finish strong. And welcome back, everybody, to the last daily market review of 2024. I won't be back until the 22nd of January, as I'm taking some time off in what's usually a quiet period of trading, the last week and the first few weeks of the year. And so in today's video, we're going to be looking at some charts, indicators, market internals, data and news, and I'm going to make a case to you why I think the market may have just made a bit of a bottom here today. I'll present to you all the evidence along with my opinions and thoughts on it all, and then I'll let you decide whether you agree with all of this. And this could indeed be a bottom in the stock market. Now, of course, I'm not guaranteeing that it is, but I'm going to show you all the reasons why I think it most likely is. And stick with me today, because I'm also going to share with you a timeline of the major news events from 2024, and also finish up with some institutional research from KKR, one of the largest and most respected global investment firms, on what they see going into 2025. And I think you'll find it really interesting where they think we are in the business cycle. And I'm sure you'll find that useful in making better financial decisions going forward as well. But first, let's just dive into all the most important charts we got from today and what could be pointing to a market bottom here. First off, look at the VIX, absolutely slap, finishing the week at 18.3. And we are getting some pretty nice turns out there today across the board, with technical bottoms being put in with strong volume pushes up across many sectors and key stocks, which I'm going to share with you. But just looking at the volatility term structure, massive crush in the VIX 9-day, now well below the VIX 30-day at 15.9. And so today's move has brought the volatility term structure back into contango, where the further out we go, the higher their implied volatilities are. We can see that in the difference of the front month versus the second month VIX futures contract. We went from backwardation yesterday, where the market was assigning higher volatilities to short-dated premium. However, typically speaking, when we go from backwardation back into contango, that's typically a bullish signal in the market, like we got the day after the US presidential election. And looking back in history, anytime the VIX front month goes above the second month, that's typically where bad things happen, like we saw back in COVID, March 2020. The front month absolutely blew out versus the second month, but when it came back down, that was the bullish signal. So for sure it could go back, but for the here and now, we got a powerful reversal today in the VIX term structure. That's a bullish signal, and this occurred in tandem with a pretty solid bullish breadth of a day across the board. Looking at the one-day heat map there, sea of green, so it wasn't even a rotation. Pretty much every sector finished higher on the day, even though it was still overall a bearish week. Just looking at the weekly heat map here, market still is in oversold territory. We've just seen a big thrust off the low. It was really mega cap tech that stood up the best this week, with some pretty hard falls in other sectors out there, especially the yield sensitive stuff on the back of rising bond yields. And just looking at the SPY itself, this is a strong bullish candle here, gapping down, then finishing above yesterday's close on really strong volume. Kind of a similar setup to the 5th of August, in which we did a monster gap down, then it was well defended on big volume, finished higher than where we opened. And this current setup was reminding me somewhat of December 2018. We were selling off really hard coming into Christmas as well, got really oversold then put in this big bullish momentum thrust up off the low, and that indeed was the bottom. The market went on to rally for months and months afterwards. And just looking at breadth in the S&P 500, percentage of stocks above the 20-day average, we may have just found a bottom today as well. Still really low there, 11%. However, looking back in history, kind of a similar setup to what we got back in mid-April and early October as well. And just looking at the S&P 500 index, there was the April low when breadth bottomed out. Got some reversal signals there. And it was a few weeks early, back in October. We did end up making a new low, but that was the bottom and the start of this cyclical bull market. Now going into its third year, in the 15th year of the secular bull market. And what I'm seeing a lot of today is my momentum thrust indicator fire off across the board. And not just in the big indices, heavily weighted by mega cap tech, but more in the equal weight indices and sectors as well. S&P 500 equal weight, giving us a momentum upward thrust there, which is a pretty good signal after the market sold off. Kind of shows the market's kind of held its ground and pushed really hard off, as we've pretty much flipped from really bullish sentiment to very quickly being oversold bearish settlement. No doubt this latest move is shaking out a lot of weak hands in the market, and I think even though the Fed did change their tune on Wednesday, it's not all that big a deal that the Fed's going to cut only twice instead of 4 times, even if they don't cut at all. That's a good sign the economy's on solid ground. They don't need to stimulate. So I think this could be a classic shakeout. Funny games by the Algos, going into triple witching today as well. Got rid of all that excess froth, and they've got in there over the last couple of days earnings and gobbled up the dip. And I'm going to show you a bunch of stocks where it looks like that's really happened. But just going back on the equal weight index, the last time we got that momentum thrust off a low, we have to go all the way back to actually late September 2022. And that actually marked the low of the bear market of 22 when we got those momentum thrusts off the low there. And that was the official low on the 13th of October. Massive bullish engulfing pattern we got that day. Also good to see the same pattern in high yield bonds. Gap down, actually closed above yesterday's high. Gave us a bullish engulfing pattern on a momentum upward thrust as well. And the same bullish signal on some key sectors. Financials firing off there today. Even utilities, which have been beaten down really hard these last few weeks, along with REITs as well. Significantly oversold here in some of these major sectors, giving us strong bullish signals here. And remember, we're still on the cusp of a really bullish seasonal period in the market. The last couple of weeks in December, going into the first couple of weeks of January as well, after we've had a good year in the stock market, that's typically a bullish setup. And we can see that in my seasonality forecast. 21 trading days, which is approximately 1 calendar month. And just looking at some of these other beaten down sectors, which didn't give us the biggest thrust off the lows today. However, we're starting to see a lot of volume in them. That's typically what you see around market bottoms and tops. A lot of volume with the price kind of just grinding. Here's energy almost 10% below its 50-day VWAP. And some of these sectors could be setting up for an epic V-shaped bottom, especially in others like home builders as well. Super stretched here. And looking at some key stocks like Pulte Group, big volume coming in here today, pushing up off the lows. Other stocks as well like Builders First Source, big volume defending these lows. And still one of the strongest sectors out there, financials. Regions Financials and some other regionals catching a bid there. Fifth Third Bancorp. And just looking at some of the biggest stocks, remarkable move. Even got a momentum thrust up here at the highs for the largest stock in the market, Apple. Almost at a 3.9 trillion market cap. This looks set to be the first ever 4 trillion market cap company in the history of the stock market. And in morning trade, it actually took out yesterday's lows before finishing well above yesterday's highs. Nvidia holding ground as well, although not as strong. Microsoft on a bit of a spinning doji. Did gap down, but it held. Big volume, scooping up the lows in Alphabet as well. Did see Tesla continue to pull back, however, it got super hot starting this week off. No surprise to get a bit of a pullback there. And stick with me because we'll come back to the charts later and I'll show you a bunch of other hot stocks out there today, along with some old favorites from the market many years ago, actually catching a bid today as well. But before we come back to those hot stocks, let's just continue on with a bit more market and macro analysis. So yesterday, the fear and greed index was an extreme fear zone at 22. Gave us a little bit of a bounce today. Another potential signal we may have just seen a bottom. Typically when we get those V-shaped bottoms, the actual bottom happens really quick. It's just kind of a fleeting opportunity, a moment in time that doesn't last long. It's an old saying in trading. Good prices don't last long. So we may have just seen that first thing this morning on the gap down. And just looking at where we were yesterday closed, percentage of S&P 500 stocks with an RSI below 30, indicating oversold conditions. We hadn't seen that since September 2022, and that was when the market last bottomed. So we did quickly flip over the last 2 weeks from being uber bullish to uber bearish. And just some good stats from Sentiment Trader today, looking at the S&P 500. After cycling from the worst breadth day in 90 days to the best within 3 days, like we just did. Like I said, we just did a massive flip from really bad market breadth the last couple of weeks, kind of escalating and reaching potentially a blow-off top early this morning. We then turned around and did a really bullish breadth of a day across the board. Looking back in history, pretty bullish going forward. 1 month and 2 months later, market's higher 80% of the time. And 3 months, 6 months, and 12 months later, the market's been higher 85% of the time with pretty good mean returns as well. 6% in 3 months, 10% in 6 months, and almost 15% a year later. And just zooming in on this chart here, you can see in prior times, this has happened, typically been around market bottoms. But this time, we're not even that far off all-time highs. Kind of have to go back to the mid-50s to see a similar setup. And so what may have saved the day today was the Fed's favorite inflation gauge coming in a bit better than expected. Could have gone either way if it came in hot. But looking at headline and core readings, they did come in 0.1% across the board, lower than what economists had been forecasting. With the core PCE index up 2.8% from a year earlier. Like we've been saying this year, 3 could be the new 2 because the market seems pleased with that. But like we've also been noting, inflation may have bottomed out around the mid-high 2s here in PCE and CPI. So I think upside risks are more likely for next year than downside risks, of course, at this stage. And I'm sure what also helped the rally and buy the dip today was Chicago Fed President Austin Goolsbee, kind of sounding pretty dovish, still saying they think they can cut rates a fair bit more over the next 12 to 18 months. He's really confident that we're still on a path to 2% inflation over that period of time as well. And this is kind of just what the market needed today, was an influential person to come out dovish and say, don't worry, inflation's still under control and we still want to cut rates. And that's what likely caused a bit of a pullback in the 10-year as well, briefly getting down to under 450 today. before finishing a little bit lower after it had been firm these last couple of weeks as well. And the market's expectations of inflation still hovering around that same level to where we were prior to the election. But could be fair to say it's now consolidating as we weren't able to make a new high this week. Same with commodities versus treasuries. We haven't exactly broken out on the upside here. And if so, that would be the market pricing inflation around the corner. Still could happen. That's what we're keeping an eye on. But for the here and now, the market's not getting too carried away with inflation expectations. And what happened this week in financial markets may have just been the process of swallowing a new Fed path going forward. Market thinks they'll stay on hold in January, which I probably agree with as well. The Fed will want to see what tariffs are going to be, any immediate reactions to that, and then they're pricing in one more cut in March. So the market may have just swallowed the fact we're only getting one more rate cut, maybe none. Like I said, it's not something to freak out about. The Fed going on hold. It's more when the Fed's cutting that the stock market can take a nosedive. And like I said, we may have just seen a classic shakeout these last few days, allowing big money to get in there and gobble up the dip, because we're still getting good economic data prints. University of Michigan Consumer Sentiment Survey, pretty much coming in line as expected, 74. However, that's been upticking these last few months, like we can see on this chart here. So that's a good sign. Consumers are starting to feel better after it really came off in the middle of the year. Although back then we had high gas prices, quite a bit of political turmoil and uncertainty. Biden resigned, and then the market started warming up to the fact that Trump was most likely to win the election, for which he did. And a landslide victory, won the popular vote. Most people got their chosen leader. Price of gas is coming down, and consumers are feeling pretty good going into this holiday spending period. And just looking further underneath the hood of the US economy as well, some key inputs. US rail traffic, the latest data we've got, pretty good. Total traffic up almost 5% last week versus the same period last year. Goods have been moved around the economy. And just looking at the Federal Reserve's own GDP Now forecasting model, straight from the horse's mouth. Their latest estimate today, the US economy is currently tracking at an annualized growth rate of 3.1%. That's a very healthy reading. And again, really against consensus coming into this year. As was widely believed, once again, just like last year, we were due for a recession. However, to get a recession, you need GDP to roll over, and you'll also see corporate revenue and earnings rollover as well. However, what you're looking at here in the blue line is S&P 500 revenues per share, currently sitting at all-time highs. You can see it rolled over a bit there in COVID. There's the GFC, then the recession in the early 2000s. In the red here, S&P 500 operating earnings per share, EPS, all-time highs breaking out. And looking back at the last 3 recessions, you can see earnings actually start to roll over before we get the recessions here in the gray. Saw that in 2000 as well. And it doesn't look like it. I would say the most remarkable thing about this chart is the bottom line, the green one, S&P 500 profit margin, sitting at 12.6%, still a little bit down off 2021. However, look at that overall trend. Higher highs, higher lows. That's a secular uptrend, and how profitable large American companies are, how efficient they are. And that's thanks to mega cap tech, who are absolute cash machines. And still this year, and expected for next year, to grow at double digits. This on top of excess liquidity, the ease of investing in US stocks from anybody around the world these days, along with the US dominating global technology, along with record buybacks, the list goes on. These are all really strong structural tailwinds for the US stock market. But for sure, don't get me wrong, valuations are stretched. Historically speaking, looking at the Shiller PE ratio, kind of like the 10-year PE on the S&P. Now, it's not too hard to see online. We get videos like this every day from the largest financial YouTubers, just like they have done every day for the last couple of years, screaming about valuations and why we're on the cusp of a crash. As many of them argue, we're so well above the long-term average, which is somewhere around 16 or 17. They think for no other reason than that it must come down. We should have the same valuations in the stock market that we did back in the 1880s. However, my regular viewers know that I make an argument that valuations are in a structural, secular, long-term uptrend for many reasons. Because to properly model data, you want to draw a line of regression, which would look something like this. And so investing back in stocks 50, 70, 100 years ago was a lot more risky than it is today. Just like it was more risky to lend money back in those days as well. Not everybody could be tracked digitally. People would disappear, go to war. Average life expectancy was under 50, so on and so forth. Financiers asked for a much larger interest rate to compensate for that risk, and so would equity holders as well. However, through the rise of institutional investing, index funds, pension funds, the Fed put in the late 1980s, and like I said, everybody these days can invest in US stocks through a smartphone, technology dominance, so on and so forth. I believe valuations are in a secular uptrend. That's not to say that they're cheap here. We definitely could revert back to this mean at some point over the next couple of years. However, I'd be very surprised if we ever saw the CAPE ratio below 15 again in our lifetimes. It was only briefly there for literally a couple of weeks deep in the GFC. And like Warren Buffett said back then, it was like shooting fish in a barrel, how cheap stocks were. And another thing about the US stock market, and I guess you could say this about global developed markets in general, is they're becoming more concentrated over time in nature. A lot of people will be surprised to see the number of stocks in America actually peaked out in the mid 1990s. There was more stocks traded back then than there is today, looking at the number of listed domestic companies. And that's because larger companies are buying up more and more smaller companies, and not to mention how dominating technology is. Apple, Amazon, Microsoft. Who would have thought 20 years ago Amazon would dominate in the cloud with Amazon Web Services, AWS? But that's the power of these big tech companies. And so that's another secular trend that squeezes the indices higher as well. But I wouldn't be surprised if the market does take a bit of a breather next year, at least consolidate in Q1. We may not get the 20% plus return we've had this year and last year. Wouldn't be surprised if it just comes in mid-single high digits, like we can typically see in the third year of a bull market. However, we need something big for this 15-year secular bull market to end. Could very well last throughout the rest of the 2020s. Got a really pro-business admin coming in there. It's going to cut red tape, regulation, lower taxes. That's all really bullish stuff. And I mean, there's trillions of dollars out there that have to go somewhere. And US long-dated bonds just ain't what they used to be. I haven't owned any bonds for years, and I'm in no hurry to lend to the government for 10 years either, given the state of their balance sheet, not to mention inflation risks. I'd rather own commodities. So here at Click Capital next year, we'll be closely following inflation reading, with the Trueflation Index being our key one. They're a private company outside the government using technology to look at thousands of prices in the real economy, looking at websites, retail stores, and that's ticked up a lot the last couple of months. So for sure, the upside risks are there. And that's probably what's got Jay pumping the brakes as well. And that's not to say downside risks have gone away either, from the unemployment rate spiking. Given us a recession, we definitely can't rule that out. Unemployment rate has ticked up this year, but still really low overall at 420. Just going out to a 20-year chart here, we can see the unemployment rate is actually still well lower than where it's been for the majority of this secular bull market. That actually started in March 09, when the unemployment rate was 8.7%. It kept on climbing for the rest of 09. Economy was soft there for a few years. Then we got the Euro debt crisis in 11. However, it trickled all the way down. Big external shock to the system in COVID. And that kind of just looks like a blip in what was otherwise set to be low unemployment for years. Seems we've got back to this trend. We've ticked up a bit here, but we'll really be keeping an eye on this as well, in addition to inflation. Just going down to the 1-year chart again. This were to break out to new highs above 4.3. We start getting 4.5. I think the market would be okay if it maybe got up to the high 4s, but if it were to start getting up to 5%, along with the 10-year yield really coming down below 4 into the 3s, in that situation, we would be back to downside risks. The Goldilocks scenario, soft landing, is unemployment continues to stay under 4.5, along with CPI inflation not really ticking above 3.5 either. We get those two things, the stock market should be on solid footing for 2025. And if so, I think small caps will shine next year. They may have found a bottom in their relative performance to large caps. Big political tailwinds coming for domestic companies, which the Russell 2000 is mostly full of. You could think of the S&P 500 almost like a global stock index now. Approximately half of its revenue comes from outside the States. And that's another reason why the CAPE ratio may not be the same as it once was, because that's comparing the US stock market cap to the US economy, where a lot of these big mega cap techs that drive the S&P are pretty much global companies. They're not just American companies. Something else we'll be looking for next year. I agree with Ben Carlson today. In 20 years of managing money, I've never seen more dismal sentiment for international stocks, valuations in general. So in addition to small caps, we'll also see whether international stocks can find a bottom versus American stocks. Just look at this chart. What an absolute secular bear market it's been in developed stocks versus American stocks. I'm not calling for a bottom on them just yet. This is such a persistent downtrend. And GDP and EPS growth in Europe, I just don't see overtaking the States anytime soon. Not to mention their political leaders are pretty much anti-business. Socialists have got to learn you can't create wealth by dividing it. You've got to let entrepreneurs drive the economy. And that's not to say emerging markets have done that much better either. Pretty much the same boat. So this will be a key theme to watch for again in 2025. US exceptionalism. How much further can it go? Will we see a comeback in China? Give us a pretty good 2024 and may have indeed found a generational low to start the year as well. What was the real standout was Argentina. Javier Milei repairing his country. Best performing stock market this year, up over 60%. And there's the spread of the Russell versus the S&P 500. It too's been in a pretty lengthy bear market. After having a pretty significant retrace this month, we'll be looking for this to make a low. And like I said, small caps may actually be the winner next year, as they've got really good valuations versus large caps. Forward PE under 15, along with pro-business policies for them. I think it's fertile grounds for them to outperform next year as well. Also really strong of late, ever since Jay Powell cut interest rates, along with the market pricing in a Trump win, the US dollar, along with bond yields, as financial markets priced in the US economy is and is set to continue to be stronger compared to many other developed economies. Interesting to note, looking back almost 8 years ago in Trump's first term, he said on the 17th of January, just before his inauguration back then, the dollar is too strong, and the dollar continued to slide going into 2017, following a very similar path this year actually. And I think one of the most interesting things, and maybe consequential as well, that we'll be watching next year is how is this new government going to play out? We've never seen anything quite like this. Now pretty much being driven by political outsiders, which in my opinion is why the establishment and mainstream media turned against Trump in the first place. Before him really getting into politics and people taking him seriously as a potential US president, the media used to love him. Had the most popular show with The Apprentice, was largely propped up by the media, but then when he looked like he was really going to get into the White House, he became a threat to the establishment and they turned against him. And that's not to say he's a perfect man, none of us are. But they created the Russian collusion, so on and so forth, just dragged on, even into this year. But it appears many Americans saw through that and they actually voted for a convicted felon to be the US president for the first time in history, with Elon Musk right there by his side. And so if they do take the butcher's knife to US government spending, is that going to have in the economy and markets? Could actually be deflationary, along with artificial intelligence, potentially being the most deflationary technology we've ever seen as well. So this will be a big one to watch next year. Along with, again, an expected pushback from the establishment and those from within. Like we already see many, like Elizabeth Warren and AOC, already coming after Elon before he's already got in there trying to clean up government spending. But once again, Elon, like Trump, are just the masters at trolling them back. So I wonder what controversy or other bogus BS they're going to cook up this time, and whether that has an effect on the economy and markets. Because like we've already seen for a few years now, the establishment really hates these political outsiders coming in and shaking up the system. They're all so comfortable. And in my opinion, they're just really afraid of what might happen to themselves. We'll also be seeing whether oil will take out this key support, and we do trade down into the 50, looking at crude futures. If China demand can't bounce back, along with Asia and Europe at large, no reason why it couldn't. However, I'd be surprised to see it go too much below $50 a barrel. A lot of US producers won't be able to make a profit at that price. AI is helping to get costs down, but that's more of a long-term secular trend than something that's immediately going to happen. And there's a look at crude futures. Once again, just bumping around just under $70 a barrel. It was interesting to see Warren Buffett buy the dip once again, spending almost $500 million on one of his favorites, Occidental Petroleum. Stock's actually trading at 3-year lows. So just looking at Buffett's move this year, trimming hard his largest position in Apple, over half of it. Did reach about 50% of his portfolio. Now he looks to be using some of those proceeds by the dip in Oxy. And we've seen him do this a few times over the past couple of years. Every time it dips, he gets in there and buy some. And on the back of that news, we got a pretty bullish signal here today. Another stock with a momentum thrust signal coming off a hard low. And just look how oversold some of these large oil stocks are. ExxonMobil, big volume here, spinning doji, potential bottom. Same with Chevron as well. Big volume coming into the stock here today. And no doubt triple witching played a big role into these volumes, but still, we don't always get these monster volumes on triple witching days. I would say a lot of this stuff has got to do with how oversold we are. And like I've been saying, in my opinion, maybe a potential shakeout that big money came in and took advantage of today. And of course, one of the biggest themes this year, Bitcoin. How's that going to play out next year? We're going to see the first ever national reserve of Bitcoin by the US government. Will that help to drive Bitcoin to 200,000? Some say we're likely going to see 300,000, even 500,000 in Bitcoin next year. How much further is MicroStrategy's infinite money glitch going to be pushed? Are they going to become one of the top 10 stocks in the US stock market, like some people are calling for? And there's a look at the Bitcoin daily to dip down earlier this morning as well, before it looked like there was a potential buy the dip there as well. And just going out to a yearly 12-month chart on this, that's what it looks like unlogarithmic. However, even changing it to a log chart still looks pretty stretched. So it's been compounding at over 50% a year throughout this secular bull market. Just keep in mind, Bitcoin has never seen a real bear market. Many people convinced that it's going to keep doing this, or at least 30 or 40% a year infinitely. However, I'm not so sure about that. I wouldn't be surprised if it does get to 200,000, could still have an epic blow off top. But let's just see how this plays out, especially when tech stocks end up rolling over as well. Because like I said, just going down to a monthly chart here on Bitcoin and overlaying it with the ProShares Triple Q, the leveraged tech fund, there's a remarkable correlation between Bitcoin and leveraged tech. Almost trades in lockstep every single month, just how well it correlates together. And if we just look at the ProShares Ultra Pro QQQ, the leveraged tech fund here, kind of like Bitcoin's done remarkably well this secular bull market, but like Bitcoin has these monster 80-90% drawdowns and just sitting currently below all-time highs. However, if I overlay this chart with the leveraged gold fund, whilst there has been a bit of correlation this last year as both Bitcoin and gold has done well, if we go back in history, we can see the correlation is not really there for the most of this secular bull market. In other words, gold trades a lot different compared to tech shares, whereas Bitcoin's almost lockstep. So there seems to be a consensus out there that Bitcoin is the new store of value. It's the new anti-fiat asset, but you can make whatever fundamental argument you want. Technically speaking, it correlates really well with tech shares, whereas gold does not. It trades a lot different. And like I said, anybody can argue whatever fundamentals they want, but the technicals don't lie. And whilst blockchain technology is real, has a lot of use cases, digital payments definitely going to be a thing. Don't have a problem with the technology behind Bitcoin. Just think the valuations and expectations on it could just be the biggest symptom of this secular bull market. And so that's another thing we'll be watching next year. The explosion in options trading. Is this a secular trend? Or is this a bit cyclical and we may actually come down over the next couple of years? Not to mention the explosion in 0 days to expiry and just how many people are all in on this type of stuff. Just a couple of days ago, I saw on my feed, my liquid net worth is all in on MicroStrategy and Bitcoin, and I've never felt more comfy in my entire life. Higher. Like I said, the expectations of higher prices in Bitcoin next year has got to be the most widely held consensus I've ever seen in my 20 plus years of trading. Very, very few people are calling for lower Bitcoin prices next year. So if that were to happen, that would upset a lot of people. Keep in mind with markets, the maximum amount of profit to be made is when the maximum amount of people are wrong. And so it's not hard to see why. The temptation is great for all of this stuff. Interesting piece in the journal today. More men are addicted to the crack cocaine of the stock market. Gamblers Anonymous meetings are filling up with people hooked on trading and betting. Apps make it as easy as ordering takeout, and it's true. I see it all the time in my social media feeds, all across YouTube, cryptocurrencies, 0 day to expiry options, and day trading. There'll always be grifters out there selling the dream of easy riches. The stats are 90% plus of retail traders that trade short-term options, that day trade, that trade CFDs, FX, all that over-the-counter garbage, they lose money in the long run. You can have a hot few months, even a hot year or two, but it's basically gambling. And as my regular viewers know, I always recommend to stay away from that stuff. Certainly is tempting. However, like I always say, if you want to gamble, and there's nothing wrong with having a little gamble within limits, small amounts of money you can afford to lose, you're better off at the casino. You've literally got better odds than trying to beat the algos, overcome the spread and commissions, and plus the casinos will give you free drinks as well. Good luck getting that from your broker. And that's why the stuff I preach, just being long stocks and ETFs with no leverage, no shorting, no day trading, no 0 days to expiry, that's kind of the boring stuff in investing. However, I believe that is what works best long term, but for sure, it doesn't have the same appeal to those looking for easy riches. So it'll be interesting to see how much further this kind of froth goes on for. And like I said, it very well could last as long as the secular bull market lasts. And then we'll see how all that stuff does when we get a real bear market, which could still be a few years away. And so those have been some key themes this year, along with mega cap tech, US exceptionalism, really just breaking away from the rest of the world. Not to mention the valuation gaps from within the US stock market between large stocks and small stocks. See whether that gap can close. How are tariffs going to play out? Is Elon Musk really going to be able to cut $2 trillion from the US government's annual spending? What effects that going to have on the economy and markets? Is China going to bite back? Are these wars started in the last couple of years going to be resolved? And last but not least, I thought I'd share with you some interesting research today from KKR, one of the largest global investment firms, and their global macro trends report they just released that contains their outlook for next year, with a research report titled Glass Still Half Full, starting off saying, without question, we are living in extraordinary times where perspectives on the world vary dramatically. And so there's a lot here in this report, which of course I don't have the time in this video to go over, but I'll put the link to this report below this video for those interested in taking a look. Check it out. It's got some pretty interesting perspectives, really good institutional research covering many areas of the market. But I'll just point out something I found the most interesting just looking through this report myself, and I'll just zoom in here, is they've got their own proprietary cycle indicator. Many people argue whether we're in late cycle, mid-cycle, early cycle, as it can be very subjective and up to interpretation. However, this is their proprietary cycle indicator and what goes into it, looking at macro indicators. And I think it would surprise a lot of people for them to say their US cycle indicator has been in contraction since 2022, but is now inching back towards early cycle territory. Just looking at their chart here of their proprietary cycle indicator. And that's something I'd been noting over the last couple of months as well. As funny as it may seem, we've actually been seeing signs of early cycle, bit of a pickup in IPOs, M&A, along with smaller companies' earnings coming back as well. And so we still can't rule out the possibility this could be like a mid-90s setup, and the secular bull market may not be over just yet. And they also said the Mag 7 reached a scale where they actually have an impact on the macro. And I'd agree, they're so big big now, it's almost like a tale of two markets. You got mega cap tech, then everything else. They kind of trade like that as well. Really seen that these last 2 years. See some days the whole market's down, mega cap tech's up, and vice versa. But again, it's hard to see them slowing down and how profitable they are. But like I said, the gap between their earnings and small cap earnings is set to narrow even more next year. And just going out to the monthly chart on the Nasdaq does look a bit stretched there, just like the S&P 500. But just going over the Russell 2000, it's looking a bit better. We have had a sharp pullback this month, but last month we did break out brand new all-time highs. So I'm still favoring small caps over tech next year, but that doesn't mean I don't have any tech exposure. I'm just favoring small cap tech. And as promised earlier, just to look at some of the hottest stocks in the market at the moment, quantum computing still holding up here today. There's Rigetti, one of the largest, IonQ, momentum thrust, and other hot parts of the market, drones, unusual machines trading up, along with Red Cat up 18% today on big volume. eVTOL stocks really hot these last few months. Archer Aviation, momentum thrust. Space stocks still holding up with Rocket Lab, and one of the best performers of late, SoundHound AI, just continuing to rip here. And I am seeing activity in some others, like fuel cell stocks and Plug Power, catching a bid there as well, and some other interesting biotech names. Ginkgo Bioworks, ticker symbol DNA, momentum thrust up there today, along with some old school stocks, like I said earlier, Sirius, strong move off the low there today. And does anybody remember BlackBerry? This is still a thing, still hanging around, traded up really strong there today after a good earnings. A lot of volume coming into the stock, and just going out to a monthly chart on this one, we have to go back. Sure, plenty of you guys remember how big they were in the early 2000s, going into 08, and this is where the iPhone came out in 2007, and ended up becoming the #1 smartphone and pretty much taking all that market share away from BlackBerry, and it's since had to reinvent itself. It's not even really a smartphone maker anymore. They're more into security software and services. But prior to BlackBerry, going back even further, I'm sure some of you remember Nokia. They were the monster before BlackBerry in the 90s. They absolutely dominated the mobile phone market. And isn't it funny how things change? People just think they're so dominant. How could they ever be taken over? They're just everywhere. Everyone's got one. But the only thing that is constant is change. Looking back in history, capitalism kind of like capture the white flag game. Those that get it rarely hold on to it for long. Before someone else, more younger, more lean, more hungry, comes along and takes it from them. That's what we saw with Nokia. And even to this day, they're still well off those highs. Completely different. Not saying this is going to happen to Apple, but wouldn't it blow a lot of people away if in 10, 15 years from now, iPhones are no longer the dominant smartphone? All right, guys, that brings me to the end of the daily market review and the last one for 2024. Just to sum up my thoughts, I think it's likely we just put in a bit of a bottom here in the market, looking at the S&P 500 index, and more importantly, the equal weight as well. We got a really bullish breadth of a day just after we hit those extremes and breadth readings. Fear and greed index, getting a lot of solid turns out there today, momentum thrusts, and like I said, the economy, GDP, corporate earnings still on firm ground. Pro-business admin coming in. No reason why the market still can't be excited by that, especially now we're trading underneath the levels we were the day before the election. The overall long-term uptrends are still intact, heading into a seasonally bullish period. Of course, we've got a little unknowns with tariffs, but even in the worst outcome of tariffs, no doubt we'll have a bit of volatility, but that could be short-lived, and I don't think it's a valid reason to completely destroy a 2-year-old cyclical bull market, the AI boom, nor knock over a 15-year secular bull market that we're still in and may indeed have a few more years to go. Looking back in history, they can go for 20, even 23 years or more. So even though it's been a pretty tough few weeks here, we're seeing some drawdowns in the portfolios. Wasn't the most ideal way to finish 2024, but that's the stock market for you. Always keeps it interesting and challenging. Our jobs as traders and investors to tolerate that, as this stuff does happen from time to time, and it can actually present good opportunities for those of us that don't get shaken out. And that's why I'm excited about 2025 and all the opportunities it's going to bring to us. So a huge thank you to each and every one of you for watching my videos, sticking with Click Capital, and supporting this channel. I truly do appreciate all of you guys. And so I'm taking a few weeks off now to recharge my batteries, spend some time with family and friends, and come back even stronger in 2025 and do my best to help us all successfully trade and invest in 2025, as I'm sure it'll be interesting and challenging as usual. And so I just want to take this moment to wish you and your family a safe and relaxing festive season, and I look forward to getting back in the swing of things come the 22nd of January. That's all for this year. I hope you enjoyed this video, and I'll see you again in a few weeks. Take care, and as always, cheers.